Hey there, Blockhead Traders. Here at Blockhead Traders, I must inform you that we are not financial professionals. Nothing we say should be considered financial advice. We offer our own thoughts and opinions to you, the viewer. We expect you to take these opinions, form your own financial conclusions, and make your own financial decisions. This is Blockhead Traders for the week of October 19th, 2025. And in this week's episode, we are going to take a look at a little topic called price action again. It's been a while since we touched on this, and the beauty of price action is price action doesn't lie. And really, it's something that is a fun topic to dive into because really, at the heart of it all, you just simply trade the chart. And we'll talk a little bit about what that means and why price action is really kind of important and pivotal in there so that you can trade what you see and not what you think. But before we hop to that, I want to give a shout out to the Discord, link in the description below. You can hop in there, say hello to myself, Viper, some of the other Blockhead traders. Love to hear what you're trading, love to hear what type of content you want to hear about. Also, you'll find a link to thetagang.com/sprocket888 as well as /ViperXL007, where we post each and every one of our equity trades, the good, the bad, and the ugly. Last, this is available in an audio-only format wherever you get your podcasts. So look us up, subscribe, and if you can't find it there, let us know and we will get it there. But let's hop to this week's content. Viper, I want to dive into price action in this week's episode. But before we kind of hop to that, I want to start off with a little bit of a story that I had that I want to kind of cover. So interestingly enough, before you kind of approach me or you approach me with the topic of this week's episode is price action, I was out to dinner with some friends this evening, some coworkers, and we were actually talking about trading and things like that. And one of the coworkers was saying to me, well, trading's all well and good, but I don't have time for that because it takes extreme precision and you got to pay attention to every minute because you really got to know when somebody is dumping all the shares because that's the right time to buy. And I kind of thought about that for a minute. And I said, well, that is a way that you could do some of that, but fundamentally, it's more about kind of looking at the chart to kind of see where things are headed. And we had a nice dialogue around that, and it just kind of reminded me of when I started trading and how confusing that I found charts. And I ended up, dumping indicator after indicator after indicator on there, thinking this will help, this will decipher these candles, this up, this down, this, left, right. What am I looking at? Because it was kind of like looking at the sky and saying, yeah, I see clouds. What do you mean you see shapes? What do you mean you see a bull? You see a bear? And I was kind of just indicator crazy on things. And then you started kind of introducing this concept of price action. Some of the other traders in the Discord actually, I would say, are the fathers of charting and price action. And I think they taught us a lot. I don't think that we taught them much. But really, it came to throw all these indicators away and just look at the chart. Just look at the raw chart and don't filter it. Don't muck it up with all this other stuff, which are all basically kind of backwards looking things. And it's not an easy thing to get. It took a lot of time, and I still wouldn't say that I have it right. But the level of added dimension that it can bring to your trading game is just super valuable and super important. And so I want to take this time in a minute here, Viper, to toss it over to you to talk a little bit about some of the basics of price action. We've done many episodes on this way back. In fact, you probably can, if you have lots of time, go through a lot of them and really see how both Viper and I started understanding more and more about price action and how it goes and how it went to bring us to kind of the level that we're at now. But the reason I say this is because I have a very mechanical trading strategy. I use it day in and day out. It's my bread and butter. But once I added what I call, the sprinkles on top of this price action, it really just kind of added another dimension to my perception of probability. And so much so that Viper this week, I'm actually managing 17 individual positions going into expiration on this Friday of this trading week, and every single one of them, I pulled up the chart to kind of look at the price action to kind of say, okay, how am I managing this? Is it time to cut and take the loss? Or do I have room left, or selling the put, buying the call, and all these different things. And that ability to kind of see what things and how they might play out really gives a different perspective on things when you layer in price action. So I'd like to kind of toss it over to you, and I won't profess to try to be able to kind of explain this. And I know, every day you and I are still learning it. And the best way that I can say to learn this is to practice it day in and day out. Even if you're not trading something, chart it, draw the lines to, the stuff that Viper is going to talk about, and just iterate it out. You don't even have to have a brokerage account to do this, and see how it goes over time. And I think you'll be really amazed once it starts to click a little bit, and then you'll think, wow, how did I ever look at this and not kind of see these things? Things will just start to jump out at you right away when pulling up any chart after you build that muscle memory. So Viper, I'm going to toss it over to you to let's talk a little bit about price action.
Indeed. And yeah, like you said, we've covered this topic many, many, many times, and I would bet significant capital that the conversation has continually matured and evolved and is far from over on the topic. To your point that we are by no means professionals, we're just constantly growing. And every time we talk about this in this setting, when it's this reflective and experience conveying perspective, I always go back to the episode I still have not watched and probably never will because I imagine it will be so cringe for me to see. But I should go back and see it at some point. I don't know. Maybe the holidays when we get together, we'll have to pour some drinks and watch it. But the very first price action episode, I know from experience, from what I remember in that episode, it was rough because I just remember just a blasting of ladder, just tons of vertical or horizontal lines. So you could go back and watch that, and then watch this just to see. And the point of that is not to be like, look how wrong we were, because I don't think Sprocket chimed in too much in that episode. But it's not to be like, look how wrong we were. It's to show the growth of, at that point in time, that was the best I had. And, what we do here, that was my conveying of my learning process, far from being professional on it. So this is just an extension of that. And so, yeah, this came about as a viewer request, if you will, of a friend of mine that is getting into, it has been in trading, and has been more in the hodl mindset, has been buying some things, holding them for a long period of time, seen them go into profit, seen it come back out of profit, bought some more, seen it go back into profit, and then is now starting to play through like, I wish I could capture that better. Essentially swing trade, but he certainly does not want to be very hands-on and just kind of wants to, I don't know if it's an appropriate title, but casually swing trade. And not in a like a lazy way, but just kind of like I don't have time to focus on this as like an intraday day trader. But there's clearly, like, because he's touching the thing, because he's experiencing the market over time, he's becoming more aware of, what, I could be more efficient with my capital, and I could take a little bit of profit. And then when it comes back down, I can redeploy that and, do things like that. So, very natural progression, I would say, to a lot of people's stories and experience. So, I kind of wanted to revisit that idea of how do you, from that perspective. So again, this is not trying to catch every single move. This is just, meant to be sort of a beginner's guide of my best advice to how to look at a chart to gauge that level of exit entry type of situation, just to be more efficient with that capital. So So let's jump on over here and take a look at this beautiful chart, which you can't see because I want to draw some stuff. Let's draw some pretty lines. So, I mean, this part is going to feel obvious, and it's certainly going to feel idealistic, but I just want to kind of introduce, obviously if something is in an uptrend, what you want to be seeing is when people say higher highs, higher lows, the classic up and to the right pattern. Notice very few things will, just whoop, completely go exponential. If they do, don't touch it because that is a whole nother thing as far as just the harder something moves. And when we talk about elasticity of the market, a bigger, more dramatic move is a good time to practice emotional discipline and just sit on your hands and don't touch it, because faster something moves, the more it's going to correct. It could be shooting to the moon, but if you jump in after the move started, you are likely going to have to stomach a significant drawdown, even if the trend continues. So we're ignoring that for a second, and we're just focusing on a traditional uptrend where, like I said, you see higher highs and you see higher lows, and this is just easy peasy to understand. But that's the golden pattern, we'll say. And then obviously in reverse would be lower lows, lower highs, and that would be the golden pattern of a downtrend. So that's ideal. Obviously, if you see that, I mean, you can practice that. You'll certainly see it on charts. You'll certainly see that pattern where maybe it goes up and it comes down right to the top of the previous high there. Then it goes up and then down to the top of the previous high. And if you're seeing that pattern, absolutely, if, let's say you started looking at this stock on this high here, it pulled back. You saw it go up to here, you see it pull back. And if you look at a chart and you see a bottom that's near the top of a previous high, that's a perfectly acceptable entry. And I'm going to leave it at that because I don't want to get into too much of the technicals of like, well, what's the best entry? Like, this is a learning exercise. So you're not going to ape in the entire mortgage or anything like that. That's a perfectly acceptable time to buy because your thesis is I acknowledge an uptrend and I'm not buying on any part of this run here. Do not touch this run up. You always buy on a pullback. Make that a fundamental rule of beginnership. You could be wrong. It could continue to fall down here. But you would much rather have entered here, which again is tied to this previous high, rather than have entered here and then have to go through the emotional pull down to here, and then it slips and it misses, and now you got double emotions going on as it pulls down here, and then perhaps then continues the trend.
Yeah, Viper. Actually, one of the things that I brought up in that conversation I was mentioning earlier, because he was really, when they were talking, it sounded like they were trying to really time the bottom or the best time to buy. And I said, there's one thing that you got to start with, and this is, I think, important for everybody to hear, is you have to come to terms with the fact that you will never, ever buy the absolute bottom, and you will never, ever sell the absolute top. And if you just convince yourself of that, that's where it becomes more palatable to do what kind of Viper is calling out here. Is all you're looking for is a decent entry point. Just set aside perfection and say, you know what? I'm not striving for perfection. I'm just looking for decent and correct. And I think that will help guide some of your thoughts and your mental games.
Yeah, absolutely. And kind of building on that, think of it from the journey perspective. A beginner trader starts, very similarly, where it's just buying stuff and holding it and waiting for the moon, that sort of thing. Nothing against that. That's perfectly fine way to start. Because generally speaking, in the stock market, things are up and to the right over a long enough time horizon. So when you do that long enough, just like I mentioned earlier, you start to think about, how can I be more efficient with this? that's going to be your driving motivator for any change you make to your system. And so the thing that made you go from how can I be more efficient on just holding something, it's going to be the same thing here. Like I said, this is a perfectly decent entry. It's not perfect, but it's perfectly decent. And it will work better than what you were doing, just spot holding it. And then over time, you continue to do that. And then over time, maybe the question comes back up. How can I be more efficient with this? And just let that be your guiding North Star on when to make the strategy more efficient. Because I think essentially that's how I would distill down, no matter what the strategy is, whether it's options, whether it's just investing, whether it's, whatever it is, it's a journey of becoming more efficient when you acknowledge the importance of that efficiency. So that's the general rule of thumb, but obviously we don't always get those perfect things. And oftentimes we'll, see these weird, patterns like this, and it's just doing all this weird stuff. And that can be super intimidating because it's like, I want to see the perfect thing. I just wanted to see the perfect pattern, the golden pattern, and buy high or buy, buy high, buy low and sell high. And honestly, again, stick to that gut feeling. If you see something like this, you're going to be extremely tempted to try to force the trade. If you see something like this and it's just like, I don't know what to do, perfectly acceptable answer. I don't know what to do. So why would you throw money at it? Wait until you have that confidence. And if you don't have that confidence, dig into some learning, understand. I mean, at this point in the age of LLMs, take a screenshot of the chart and toss it to Claude or GPT or your LLM of choice. Just toss it there and be like, I wanted to go long on this, but I don't know what to do here. And it'll help you reason through that to keep you from throwing money at this. But so that's the gist of the pattern, the golden pattern, the chop pattern, and initial reactions to those. So that's all well and good. But let's take a look at some actual data here. I asked my LLM of choice to just give me a random ticker, and it gave me Microsoft. Not very creative, but it'll work. And so we're gonna stay looking at the daily chart here because, again, from this perspective, you're not trying to swing day trades or anything like that. You're just trying to get exposure. I guess as much as I threw shade on it, Microsoft's not a bad ticker because you want to position yourself for success. So picking a ticker that is generally up and to the right is going to be best for this strategy, because worst case scenario, you're just holding on to it and waiting, for profit. You're dipping your toes in the market waters by saying, I want to try to sell a little bit. You're not full exiting. I just want to try to sell a little bit and then buy a little bit more when it dips. Very safe operating conditions there. So if we take a look at this, there's two things. So the one thing I wanted to do here, despite Sprocket's introduction, is throw a couple indicators on here.
Oh.
So these I'm going to caveat. I'm going to caveat this very heavily and say this is meant to be bumper lanes in the bowling alley. These are not pure trading signals. These are just to help you get a feel. And what I highly encourage anybody to do that takes me up on what I'm about to explain here is you can use it, look at it, learn, but watch the price action around the two things I'm about to show you, because that's going to play more into the general picture here. So what I did is you can do this on literally any charting platform. We're going to keep this uber simple. And so what I did was I added an SMA, which is a simple moving average. I added two of them. And whatever your chart platform of choice, there should, once you add them, you can kind of see them up here in the top left a little bit. Might be hard to see, but you'll see them somewhere wherever you add your chart. You'll have the ability to edit the settings of that simple moving average. And we're simply going to make one of them, the length of it will be 50. And the other one, we're going to make the length of it 200. So this is the 50 and the 200 SMA. And then you know, whatever works for you for this video, I'm going to pretty clearly delineate both of these. Orange is going to be our 200. And let's make, for visibility's sake, let's make red our 50. So what these two are is, as the name implies, these are simple moving averages. So all they are is the line represents the average price over the last X number of candles. And so in this particular case, I added the 50 and the 200. So as the name implies, the red line at any given point in time, so like here where I'm at, the red line is at $430, but the actual price is $465. So the 430 is the average price over the last 50 candles. And that's dependent on whatever time frame you're looking at. Since we're looking at the daily, each candle is 1 day. So over the last 50 days, average price of Microsoft was $430. Likewise, the 200 is the last 200 days. So what I want to say about using these is, this is I don't want to throw too much shade on it, because it is for the industry, for traders. I mean, it is a valid use case of a signal. But basically, if the price is underneath the 200, then you are most probably in a downtrend. If the price is above the 200, then you are most probably in an uptrend. And if you're seeing mixed signals, like if we zoom in here, we're just getting all tangled up here. The 50 and the 200 are intertwining, and look at what's happening to price while that's going on. Price is just chip chopping all around. This is, I mean, the reddest of red flags to just sit still. And if you were watching this unfold, so yes, to Sprocket's point, these are lagging indicators. It's an average over the past period of time. However, if you were watching this chart unfold in real time, you would see it break the 50. So you'd be like, all right, well, maybe that's problematic. Maybe it's going to do something. You'd see it touch the 200. 200 in an uptrend oftentimes acts as support. So you can see that we tried to get support off of it, but we just kept failing. And by failing, I mean we kept bouncing off of it, but we continually did not touch this previous high here. If something is support, then if it's strong support, you would touch the support and you would go do the thing you need to do. And in this particular case, to continue the trend, that golden pattern, to continue that trend, you need a higher high. So in that thesis, we came down and we touched the 200. Maybe we touch it again. At some point, you want to see it relatively quickly come get a new high here. Otherwise, it's kind of weak sauce. So anyways, when we see these two 50 and the 200 SMA intertwining with each other, the price action reacts accordingly of like just complete chop. This is a red flag, no-go zone. Just wait and see what happens. And then you can see as price plays out here, we bust through the 200, we drop below, and then we come up from underneath and we fail to do anything. And now we start to settle in to, what would this be? Mid-February to mid-April. So about a month-long downtrend here. And we're below that, we're below the 200 and we're below the 50. So this is just kind of momentum spotting, trend spotting. And then you can see once we cracked back above the 200, I mean, this was a big day. This was a gap, pretty massive gap overnight. We busted up above it, and now we're just holding steady above the 50 and above the 200. And, then we kind of blew off top here. We did our higher high significantly. And now we're pulling back, and now we're dancing around the 50 here. So I wanted to call this out because I think it's a decent, like I said, bumper lanes at the bowling alley. But I use this from time to time because it is reliable, even though it is technically a lagging indicator. But more importantly, it gets you into that visual mindset of price action. You can see it, like if we just go back in time here, you can see how price reacts around when this happens. When we get a downtrend, when the 50 starts to clearly be slanted down, the price goes down. And when the averages get intertangled with each other, the price gets choppy. And so again, I don't want you to say, well, I'm just going to focus on that and I'm only going to trade that. The more important thing is these are important levels. The 50 is an important level. The 200 is an important level. And acknowledging how price reacts at important levels is the takeaway that will translate to any chart with no indicators on it whatsoever, because you'll start to see the important levels without it being drawn for you. Because we can see the red line is important, and every time it touches it, not every time, but probabilistically, when we're in an uptrend above the red line, when we touch the red line, something happens and we pop up if it found enough support. So I don't know. Does that, just from the indicator perspective, is that too much magic hogwash, or how are you feeling on me layering in just one indicator?
Yeah, I'll let it slide this time, Viper, because really, what I think that does is a smoothing function. I think part of what kind of distracts people is the noise that candles can present, and that noise is that fluctuation up down, right? That's what kind of freaks people out a little bit. And I think the SMAs kind of smooth that noise. And I think the way that you framed it as, hey, just get this to help your mind get in the right place is the right call out. Because if you look at the most recent price action where we had that downtrend, and then the downtrend kind of reversed just before that really big gap up, if you look at that and you kind of zero in from if you pretend you were trying to trade that, right? You would have completely missed that kind of low point there if you're following and trading off of, say, the 200-day moving average, because let's say you bought at the downtrend once you dip below that 200-day moving average, but or sorry, you didn't buy. Let's say you sold it, you went short, right? And you're like, okay, we're going down. I want to short this thing, and you short it. By the time that price gets back above that moving average and that moving average starts heading back up north, you've already lost the profit that you had from the short. So that's what I mean by lagging indicator is if you're trading by that guidance alone, by the time that signal shows you something, you've already missed the move.
Yeah. Yeah, absolutely. And potentially even worse is, so exactly to your point, let's make this a little more visual for people. Correct me if I'm wrong, but essentially what you're saying is, let's say, okay, you've acknowledged we're below the 200, trend is down. We're below the 50, trend is down. And so you're playing that mindset of like, okay, so I'm going to short if we touch the 200 because that's a good entry. And so if all you were doing was watching this chart, we would touch here, and maybe you took this short, maybe you got a little bit of a short out of it. Actually, let's say you did. Let's say you were real strict. You were like, as soon as we touch that 50, I'm going to short it. And if we get down, let's just say you were looking at these two candles. So let's just give you the biggest benefit of the doubt and say you pegged this perfectly. You came down here, you had this short on, you took it off, somewhere right around here, and you're feeling great. because your system worked. It touched the 50 here. You took the short, you closed it out here, and now we come back up and we touch it again. What are you going to do? Well, I'm going to do it again. Emotions are riding high. I'm going to short this, and I'm going to be looking for us to just print on that. And instead, you get a couple days of warning of it's not working. And then you have a day, you don't even have a day, you have after hours where this thing exploded. And all of a sudden, the market opens the next day and you're sitting pretty poorly. Like Sprocket just said, you've erased your gains from this short, you've given it all back, and you're probably sitting net negative on that. So very important to call that out as to why this isn't like a trading indicator, but it is that mindset to help you visualize. So I think I'll pause on the indicators for a second because I do want to loop back around on those and try to give a little bit more tangible advice with that, because I don't want to just throw that out there and then be like, figure it out yourself. But so we're going to loop back around and we're going to make some rules around that. But first we're going to, come back to just pure naked price action here. And in the context of the golden pattern and all this other stuff, what we can see here is I hope we can start to see, just looking at this pattern here of this chart, knowing that these are the daily candles. So knowing that time is very long here. I mean, this is 2020 on the left side of the chart, and we're 5 years later, going on 6 years later on the right side of the chart. So that is to say, do not take for granted how much time is passing in this downtrend here. And so what I want to call out is that golden pattern. And so hopefully, and if you don't see it, that's fine. But hopefully you can kind of see that golden pattern playing out here. And you can kind of see that we go up, we come down a little bit here. There's a higher low. We get a higher high here. We get a higher low here. And we're doing the thing where we keep going up. And that's what you want to see. So if you were playing this, I mean, what I just showed there, that plays out over March of 2020, end of March, all the way through December 2021. So that is a year and a half of data there. So I hope it's starting to become more apparent that is all you need, is the acknowledgement of that golden pattern. And, like I said, just buy on a down, whatever it is, focus on being net long as the trend you're seeing is up. Never worry about shorting, especially in the beginning. So if it's not a trend up, then you're just not touching it. But you can see that each of these pullbacks here would be a decent entry. Sometimes the pullback doesn't happen for a little bit. We had this run here where it was just and you're just waiting. You're sitting on your hands. You see a decent pullback here. As it's pulling back, take some chomps at it. And so that's all well and good. But how do I know when it's time to take heavier profit, draw down harder, because maybe we're going to go into a long, prolonged downtrend? And for that, I would say, first of all, the biggest caveat on reading a chart in hindsight is hindsight is hindsight. Hindsight is 2020, as they say. However, we can be realistic here. And going back to what Sprocket said, you're never, ever, 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 ever going to sell the top. So right away, just take this chunk up here, scribble it out, because this was only the top in hindsight. In the moment, you would have had no idea. All you would have known in the moment is we're running up and I'm not touching it because we're running up. That's the only thing you would know in the moment. Now, what we do know from, again, the golden pattern is we want to see a higher low. So we already know, not in hindsight, but just in history of the chart, we know that we have a low right here at this like $285. So we know that we don't want to see anything happen below this low here. And so what we see in real time is, let me get my scribbles out of the way because that is distracting. Is we see that price pulls back, and this would be a perfectly good thing to have charted as it's going up and touching this. Yeah, you probably bought a little bit up here when it pulled back. That's perfectly fine. Again, like I said, you're not going to peg it perfectly in this strategy, but you bought a little bit there, and then we kept pulling back, and you very well could have had this line marked on your chart as like, okay, this is my stop drop dead level, because the golden pattern says I do not want a lower low. And so we pulled back and we touched it here. Okay, that's perfectly fine. Maybe you actually bought a little bit on this touch, but then we failed to do anything. We popped up and then we came back down, and now, and let me zoom in so this is a little bit more clear. And so now what's happening is we can start to clearly see lower lows forming, and we can clearly start to see higher highs forming. And even though this high here popped up a little bit, we're still not buying it, right? Because it's a run up. And so we're leery, essentially, is what I'm saying. When we get into this mode here, we're really not buying anything because we're seeing the lower lows. We're seeing a failure to make higher highs. We could be talking about a reversal. And so we're just going to sit on our hands. If we're really worried, and let's say we caught that whole run previously, we could absolutely be drawing down our position, taking more profits, and just waiting to see what happens here. And sure enough, we drop back into this zone. And now we're talking the opposite. Now we're in the golden pattern down, where we're making lower lows, we're making lower highs, and we're clearly trending down. And so I would guess that if we turn on those SMAs, lo and behold, I should have changed my ink color here because that it's confusing around the SMA. So I'll clear those out. Lo and behold, we dropped below that. We dropped below the 200. And sure enough, just when looking at the plain old naked chart, we were feeling uncertainty. These guardrails are confirming that uncertainty. And so I think that's where it's really important to contextualize the intent of having these SMAs on the chart. So let me just wrap it up with a couple of suggested rules, because no system is worth anything if you don't have rules to operate under, and then you can tweak those rules if things are wrong. So in this strategy, this is a permanently long strategy. All you're trying to do is harvest some profits when it's good to take profits, and then hunkering down to make sure you have capital available to purchase on the dips. So I would say some quick rules that I would be looking for on this would be, we are not buying anything. So first of all, we want to see the trend going up, and the trend going up is the 50 SMA is over the 200 SMA, and price is hovering around the 50 SMA. And if price is currently launching off of the 50 SMA, like we see, let's say right here, you're not touching it. You're not refilling. You're not doing anything. If you wanted to take some profits, then as it's launching away, once you clear the previous tower here, once you clear the previous high, you're clearly putting in a higher high. Don't try to peg it. I mean, you could have done it on this candle midway up. It's a higher high. Take a little bit of profit and wait. And you're waiting for that pullback to where it pulls back. In this case, you have a guiding light to say when it pulls back towards the 50 SMA, then I'll take another nibble and buy some. But don't fool yourself and keep it in mind. The real reason you're doing that is the pattern. We're actually, even though we came back to the 50 SMA, we're actually coming back to this previous high here. So be disciplined and keep that in mind. And then we start running again. We're not touching it. We're just holding on. We're enjoying the ride. We're not even coming back to the 50 SMA, so we're going. You could be selling here because technically it's a higher high, or you could be waiting for a pullback to the 50 and take some profit there. If if we cross under and then we start doing the lower highs and the higher lows, the lower lows and the lower highs, then that is potentially heavier profit taking at that point because you're expecting continuation down. Heavier profit taking, assuming that you had caught a decent run previous to that. And I would say I'm going to leave it at discretionary from there, because we're not shorting. So when it's in this confirmed downtrend, that's more of a turn off the chart. Maybe you take some nibbles on lower lows as they come in because that's your powder. That's your ponying up a larger position. But when it's in this downtrend, you're really focused on having taken significant profit as it transitioned, and now you're just kind of taking nibbles as we dip down, and you're waiting. You're not getting antsy to exit anything in a loss on there. You're waiting to get back into an uptrend and then start having another ride up. So in a rough way, I would say trying to form some sort of strategy that way, some sort of outline. That was far from perfect. There's, sit down, have the rule set in your mind of how you're going to do this, and then you do it. And if it's not working, if you're not feeling efficient, you have something to look at that you can tweak the rules, and then continue that proverbial journey there.
Yeah, Viper, the one thing I'd kind of add into this before we kind of close out the show here is I would highly, highly recommend doing this charting. Find a tool that preserves your marks, that you can just call up a ticker at some point in the future, and all of the things that you made a month ago, a week ago, 6 months ago are all there. Because that's where I found a lot of the power of that awareness is find a tool where you can chart it up. You don't even have to be trading it. Spot the levels, mark the levels that you think, pencil in what you think might happen from a price action standpoint, where the stock might go. Then wait, watch it, and see. Some of the best interesting things that I have done is mark levels, mark highs, mark lows on charts, completely forget about them. Something brings that ticker back into the news, and I type in that ticker on my charting software, and then all of a sudden, boom, I pull up all these old levels are there, and I'm amazed at how the price reacted over time to those levels that I had previously marked. And I think that will help reinforce some of the things that you're finding, the things that you're seeing, and gain kind of confidence. So I know Viper and I both use TradingView, but what you use really is not so important as the functionality. And to me, I think that is let it mark up and keep that stuff. Whatever device you're going to, you pull up a ticker, let it pull up your marks.
Yeah, absolutely. And I mean, it's the beauty of good fundamental price action, which this is certainly the start of that journey towards good fundamental price action. The beauty of it is it doesn't matter the ticker. It doesn't matter the market. It doesn't matter if it's an index, an ETF, stock, crypto, whatever it is. The rules of fundamental TA apply. TA, technical analysis, or price action, PA. That golden pattern, that's a golden pattern that happens in any market on any asset that's traded in the public view. The liquidity can matter to Sprocket's mantra. Liquidity is king. And so what I mean by that is if it's some super illiquid thing, the price action is still there. You're probably just not going to see it because it's glitching all over the place. So that's a minor nuance thing to it. But the thing, the high level thing is it applies no matter where you are. So if you don't like Microsoft stock, if you're not in stocks, whatever it is, the same thing applies. Grab a chart and throw some lines on it, see what happens. and you're never ever, even me to this day, I'm never expecting to call it perfectly. I'm just expecting to call a probabilistic edge and then act on that edge. And so in this particular case, your edge is identifying a trend, playing into that trend, and knowing when that trend is potentially reversed and then reacting accordingly. And none of this requires hyper focus on the markets. Like I said, we're looking at the daily chart here. So we're looking at huge swaths of time where none of these patterns are playing out in, let's say, less than a week, because there's so many candles here. So it is, I think, very fitting of that casual strategy, and the same rules apply on every time frame. So you get really comfortable in the casual mode and you're like, I want to step it up a bit. Zoom into the 4-hour chart, zoom into the 1-hour chart. It's a choose your own adventure. Find what's comfortable for you and just stay where you're comfortable. Only grow and push when you feel the internal need to want to do that.
So that brings us to the end of this week's episode. The real takeaway here is it sounds really simple, where Viper laid out look, when the chart is stepping up, we're in an uptrend. When the chart is stepping down, we're in a downtrend. Buy on the uptrend, sell on the downtrend. It seems really simple. And I promise you, it won't feel simple when you go to try it. And what I really think is that confidence builder there is to do this charting like we mentioned and we talked about. And it doesn't have to be charting that you do during the trading day. Most of my charting that I do is in the evenings on the weekends, where I'm pulling up a chart, marking it up with the things. And if you don't want to wait, weeks, months for the turnaround, practice your charting on a shorter time frame. Pull up the hour chart and chart that. Pull up the 30-minute chart that. Then you can wait a day or two and see how your lines pan out from the price action, because it doesn't really matter what level that you do the charting on as far as a fidelity, as far as the signal goes. The price action holds whether it's a 1 minute chart, a 5 minute chart, a 30-minute chart, a 4-hour chart, a monthly chart. It doesn't matter. The price action's there. Just the length of time it takes to see the results of the price action and kind of gain that confidence does change. And also liquidity does matter. So pick something that's liquid. Pick something you've heard of. Don't pick up a penny stock or some tiny little stock that no one's ever heard of. Stick to the big ones: the Amazon, the Facebook, the Tesla, the SPY, the indexes, the S&P index, the Dow index, the NASDAQ index. All of those things will just kind of help you do it. And the more that you do this, the more that you see where your lines go. Look for those higher highs, look for those higher lows, call them out, draw lines, type things in the chart, let it come back. And it's all of those things that will play into more of an understanding, more of a comfort level. And as Viper says, if you're not comfortable, just keep iterating on whatever it is that you're trying to learn, and wait for yourself to say, I'm hungry for more. I want to push this envelope, and then go push that envelope. And I think all of these things together are really good undercurrents that help build some of your understanding on how the market moves. It helps you feel better about your purchases, where you have to get into that mindset of, I absolutely am never going to buy the bottom. I absolutely am never going to sell the top. And all it's about is figuring out what is the best decent entry point. And then when you want to sharpen your skills a little bit more, sharpen your skills more, and you can maybe hone in on getting a little bit better of an entry point and a little bit better of an entry point. But nobody really ever got in trouble for taking a profit. So as long as your entry and exit are generally within the realm of those golden signals and things like that, sure, you're going to get some wrong. But the law of large numbers, the law of playing in the market consistently, is that over time, sticking to things that are probabilistically in your favor will yield you positive green results in the end. So good luck out there. Have fun. And remember, think outside the block.